Sitting in your living room, listening to the rain, and you hear the distinct sound of hail slamming against the siding. A major storm is rolling through, and your property is right in its path. Wind catches the edge of your roof, peels back the asphalt, and suddenly your home is completely exposed to the elements. The damage is severe. But you pay your homeowner's insurance every month. You assume you'll file a claim, pay a small deductible, and a crew will show up next week to install a brand new roof. Banking on that scenario today is mathematically dangerous. The era of the fully covered roof replacement is effectively over. If you assume you're protected without checking the fine print, the next storm could easily cost you tens of thousands of dollars out of pocket. Insurance companies have been hit with a wave of historic replacement costs. Between more frequent severe weather, a spike in the price of asphalt and labor, and an aging housing stock, they are bleeding money. Instead of raising everyone's premiums across the board to cover those losses, insurers found a quieter solution. They restructured their policies to shift the financial risk directly onto you. They do this right out in the open. The mechanism is printed on the policy renewal letters sent to homeowners every year, hidden behind 3 specific acronyms. You need to look at your declarations page and find out if your roof is covered by RCV, ACV, or an RPS. Wait until a tree branch goes through your living room ceiling to figure out what those letters mean, and you've already lost your leverage. Knowing how these 3 policies actually calculate a payout is the difference between a manageable repair and a devastating financial crisis. Let's start with RCV, or replacement cost value. This is the gold standard of coverage. If a storm destroys your roof, the insurer pays the current market rate to put a new one on, minus your deductible. But even RCV has a catch. Insurers use a holdback system. They write you a check for the current value up front, but they hold back the rest of the cash until you submit proof that the repairs are actually finished. Then there is ACV, or actual cash value. Under this policy, your payout is strictly based on the depreciated value of your aging roof. You might be wondering why anyone would choose this. Recently, new federal rules from entities like Fannie Mae started allowing lenders to accept ACV policies to lower buyers' monthly mortgage and insurance burdens. This comparison matrix breaks down a standard ACV claim. If replacing your roof costs $15,000, but your roof is exactly halfway through its lifespan, the insurer cuts that in half. They pay $7,500. The rest is on you. ACV provides real relief on your monthly housing costs, giving you lower premiums. But in exchange, it exposes you to massive, sudden emergency expenses the very minute the extreme weather turns. The newest and most confusing twist in policy renewals is the RPS, or Roof Payment Schedule. Instead of sending an adjuster to inspect your shingles, an RPS uses a strict, non-negotiable percentage cap based solely on the age of your roof. This step chart illustrates how fast your coverage disappears. You might have 100% coverage for the first 5 years, but cross the 10 or 15-year mark, and the payout drops to 25%. When an insurer deducts depreciation from both the materials and the labor, the initial claim check they write you shrinks drastically. This double deduction creates a severe cash flow bottleneck. Homeowners are frequently left without enough upfront funds from the insurance company to even hire a contractor to begin the work. Looking at this map of the U.S., you can see exactly where this practice is legal and where courts or statutes have blocked it. Whether you face this bottleneck depends entirely on your geography. Depending entirely on state borders, the exact same storm damage will either give you enough cash to start repairs, or instead it will leave you completely stranded with a massive blue tarp draped over your ruined living room. Insurance companies heavily scrutinize the condition of your roof when deciding whether to renew your gold standard RCV coverage. They typically trigger forced downgrades to ACV or RPS right around the 10 to 12-year mark. But you can use a mathematical strategy to beat the insurance downgrade before it happens, through proactive intervention. One proven option is chemical roof rejuvenation. This technology applies a treatment that restores the asphalt shingles at the molecular level. By restoring the oils, improving flexibility, and locking in the granules, an older roof can pass an insurance inspection testing as like new. The alternative is paying for an early, proactive full roof replacement before your policy officially shifts out of your favor. Spending a strategic amount of capital today to maintain an aging asset is often the only viable way to preserve your full RCV coverage for tomorrow. Let's look at this decision tree. If you accepted an ACV policy, aggressively build a dedicated emergency fund. That risk is yours. If your roof is nearing age 10, invest in rejuvenation or early replacement to legally lock in RCV status before a downgrade.
Whatever your situation, pull your current declarations page today, verify your acronyms, and check your state's labor depreciation laws. In the modern insurance landscape, there are no bad policies, only misaligned risks. Your ultimate defense is choosing the coverage that precisely matches your actual cash liquidity.